China has always had a very firm control over silver. Well, now what's happened is that China, first of all, has withdrawn from supplying the West. That's the first thing. And the second thing is that from January the 1st, the export of silver is banned from China. So you can see that this is creating a huge, great problem in the markets. Now, history of the derivative system, it was originally brought in and sanctioned by the US Treasury as a means of suppressing prices of commodities, particularly gold and silver, but particularly gold, by diverting demand away from bullion into paper bullion, if you like, bits of paper. And this sort of fitted in quite well with the regulatory situation which evolved in the early 1980s, whereby regulated investments were defined as stocks, shares, bonds, so on and so forth. But unregulated investments included gold, silver, and copper and other commodities. Because they were not regulated, it basically means that the compliance officers will limit what an investment manager can do in terms of investing in physical gold, physical silver, and so on and so forth. So what this meant was that there was a control on the price, particularly of gold and also silver and copper and oil and things like that, by the expansion of these derivatives, soaking up demand for them without people actually bothering to get the underlying metal. And so consequently, the prices of underlying metal didn't rise. What we are seeing in the silver market now, however, is the complete loss of liquidity. There is massive dealing going on in silver derivatives. But of course, rather like a tire hitting the road, there comes a point, if you like, where people actually want the physical. And that is beginning to happen. Consequently, in London, there's nothing to deliver, even though they've been dealing in huge quantities. And the squeeze on COMEX has been evidenced, if you like, by the fact that silver's shooting into new high ground, while at the same time open interest is declining. What the decline in open interest tells us is that the speculators are not buying it. They're not going for it at all. The price is rising not because of speculation or investors, if you like, buying it. It is rising because the system itself is close to default. There is also a shortage in Shanghai. And I'm looking at the combined stocks of the Shanghai Gold Exchange and also the Shanghai Futures Exchange. That's fallen to around about 570 tons, which is seen as close to crisis level. 600 being, you don't want to see stocks less than 600. We're about 570. There's a little bit creeping back in. I saw overnight there's about 14 tons came in or was recorded as having come into the underlying bullion stocks. But it's still a very, very difficult situation. Now, the point about this is that the use of of derivatives to soak up demand for commodities, that story's now come to an end. And it's beginning to go into reverse. Now, just imagine you have got a large number of bullion banks, hedge funds, and all the rest of it who have positions one way or the other in derivatives. And these are now questioned as to their value. As that unwinds, then the demand is going to go into the physical. So you can see that as that contract on COMEX and also forwards in London begin to collapse, and it looks like that we're in the early days of that, then this in itself, purely in terms of substitution, is going to push up the silver price very, very substantially from here. So this is the importance of what we're seeing in silver. Now, if it's true in silver, it's not far behind being true in gold. Because again, if you look at open interest on COMEX, that's collapsed, while gold has been trading at close to the highest levels ever. This is an extraordinary situation. They're both becoming what have been described as Giffen goods. In other words, the normal laws of supply, demand, and price have been completely suspended. Instead, what happens is that as the price rises, it creates buyers and reduces supply, which pushes the price up even further.
Yeah.
And that's what we're seeing. And this is actually undermining. It started with silver. I think it's going to follow through into gold. I mean, all the indications are there that it will. It's beginning to undermine the most important derivative contracts in the whole of the derivative system. Now, you may think that this is an exaggeration, but bear in mind that the banks and all the rest of it who have these positions are counterparty risk the whole way across the entire derivative landscape. So what we're seeing is the potential failure, and certainly if we don't get immediate failure, concerns that there will be a failure of derivative counterparties in the whole of that space. Now we're talking about trillions of notional value affected by this. So this is another aspect, if you like, of things that just seem to be going wrong at exactly the wrong moment, if you like.
Yeah.
So that's the importance, really, of what silver is telling us, I think. I don't think it's a load of hogwash. I mean, the story, as you rightly say, was that I think something like 50 million ounces was sucked into London when we had the failure on October the 10th. Basically, that contract was effectively suspended. We're not talking about a regulated market, but there were no dealings. It just sort of seized up for about an hour and a half on October the 10th. And consequently, there was an arbitrage coming out of China. But now that China is not only forbidding the export of gold, it is now forbidding the export of silver, or at least will be doing so from January the 1st. So this is, and I think, I don't think it's necessarily, China just saying, we're stopping to supply silver and all the rest of it. This is actually fitting in with their rare earths thing and critical minerals. And, so I think it's part of that wider policy.
Yeah.
I mean, the trouble is that also silver has become, or it is becoming, I don't know quite where we are, it's been recommended to the government that silver should be a critical mineral for the United States as well. So it's difficult to see that the United States, I would assume they've got some stocks. They won't tell us, of course. If they've got some stocks, I think that they'll probably tend to hold on to them. And this is the point about a Giffen good. Holders, rather than benefiting from a rising price, sort of take the view, oh my God, there's a shortage of this stuff. We better hold on to ours because we'll never get it back. So this is the problem, I think, that the market faces. I'm not against derivatives at all, but they have their place. But the idea of using them by governments to try and manage commodity prices, I think, is a great mistake. And now we have got 54 years of distortion here to unwind. And I am certain in my own mind that the consequences of this will be spectacular.